Imagine waking up tomorrow morning, opening your brokerage account and seeing cash deposited into your account while you slept. No clocking in, no client meetings, no side hustle, just income flowing from a portfolio designed to pay you month after month. For most investors, that sounds like a dream reserved for retirees with millions of dollars. But what if I told you there's a strategy that many income-focused investors use to target yields around 7%, sometimes even higher, without chasing the riskiest stocks in the market? Today, we're diving deep into the 7% dividend yield portfolio, a strategy built around closed-end funds, also known as CEFs, and high-yield ETFs. By the end of this video, you'll understand how these investments work, why they attract income investors, the risks hiding beneath the surface, and how a carefully structured portfolio could potentially generate meaningful passive income while still maintaining diversification. Let's start with a simple reality. Traditional savings accounts and many government bonds simply don't provide the income they once did. Even after periods of rising interest rates, investors seeking dependable cash flow often find themselves searching for alternatives. At the same time, many popular dividend stocks yield only 2 to 4%. That's not necessarily bad, especially if you're focused on long-term growth, but for investors who want stronger current income, those yields may not be enough. This is where CEFs and high-yield ETFs enter the picture. They exist in a unique corner of the investing world, offering higher income potential than many traditional dividend stocks while providing instant diversification across dozens or even hundreds of underlying holdings. To understand why these investments can generate higher yields, we first need to understand what they actually are. Let's begin with closed-end funds. Unlike mutual funds or traditional ETFs, a closed-end fund issues a fixed number of shares when it's launched. After that, investors buy and sell those shares on the open market, much like a stock. Because the share count remains relatively fixed, the market price can drift above or below the actual value of the assets inside the fund. This creates what investors call premiums and discounts to net asset value. In simple terms, you may occasionally be able to purchase a dollar's worth of assets for 90 cents. For income investors, that can create opportunities that simply don't exist with traditional funds. Many CEFs focus specifically on generating income. Some invest in dividend-paying stocks. Others focus on corporate bonds, preferred shares, real estate securities, infrastructure assets, or a combination of multiple asset classes. Many employ professional management teams whose primary objective is maximizing distributable cash flow. Some even use moderate leverage, borrowing at lower rates to invest in higher-yielding assets. This leverage can boost income, but it also introduces additional risk, something we'll discuss later. Now let's talk about high-yield ETFs. Unlike CEFs, ETFs typically trade very close to their underlying asset values because of a creation and redemption mechanism that keeps prices aligned. High-yield ETFs can focus on dividend stocks, covered call strategies, preferred securities, REITs, business development companies, corporate bonds, or combinations of income-producing assets. These funds are popular because they offer diversification, transparency, liquidity, and generally lower fees compared to actively managed alternatives. Many CEFs focus specifically on generating income. Some invest in dividend-paying stocks. Others focus on corporate bonds, preferred shares, real estate securities, infrastructure assets, or a combination of multiple asset classes. Many employ professional management teams whose primary objective is maximizing distributable cash flow. Some even use moderate leverage, borrowing at lower rates to invest in higher-yielding assets. This leverage can boost income, but it also introduces additional risk, something we'll discuss later. Now let's talk about high-yield ETFs. Unlike CEFs, ETFs typically trade very close to their underlying asset values because of a creation and redemption mechanism that keeps prices aligned. High-yield ETFs can focus on dividend stocks, covered call strategies, preferred securities, REITs, business development companies, corporate bonds, or combinations of income-producing assets. These funds are popular because they offer diversification, transparency, liquidity, and generally lower fees compared to actively managed alternatives. Imagine you're trying to build a portfolio capable of generating a 7% overall yield. Instead of placing all your money into a handful of individual high-yield stocks, you spread your capital across multiple income-producing sectors. One portion might be allocated to a diversified dividend ETF containing large established companies. Another portion could be invested in a covered call ETF designed to generate option income. A third segment might be allocated to a bond-focused CEF. Another could target preferred shares or infrastructure assets. Together, these components can create a diversified stream of income from multiple sources rather than relying on a single company or industry. One reason investors are attracted to this strategy is the psychological benefit of consistent cash flow. Market volatility can be stressful. When stock prices fall, many investors panic because they focus entirely on portfolio value. Income-focused investors often view their portfolios differently. They pay close attention to the income stream being generated rather than daily price fluctuations. If a portfolio continues producing reliable monthly or quarterly distributions, some investors find find it easier to stay invested during market downturns. However, this is where many beginners make a critical mistake. They assume a higher yield automatically means a better investment. In reality, yield alone tells you almost nothing about quality. A fund paying 10% may actually be riskier than a fund paying 6%. Some distributions are generated from genuine investment income. Others may include return of capital, which means part of your own money is effectively being returned to you. Return of capital is not automatically bad, especially in certain tax-efficient strategies, but investors must understand where distributions are coming from before making decisions. Let's look at a hypothetical example. Imagine a portfolio worth $100,000 generating a 7% annual yield. That portfolio could potentially produce around $7,000 per year in distributions before taxes. Broken down monthly, that's approximately $580. For some people, that's enough to cover utility bills. For others, it might pay for groceries, insurance premiums, or contribute toward retirement expenses. Scale that portfolio to $500,000 and the income becomes significantly more meaningful. At $1 million invested, the numbers become even more substantial. This illustrates why income investing attracts retirees and those pursuing financial independence. But generating income is only half the equation. The other half is preserving capital. If a portfolio yields 7% but loses 15% annually in value, the strategy may not be sustainable. Successful income investors pay attention to total return, which includes both income distributions and changes in asset value. A high distribution rate means very little if the underlying investments consistently erode over time. This is why diversification matters so much. Different asset classes perform differently under various economic conditions. During periods of rising interest rates, bond-focused funds may face pressure. During recessions, economically sensitive dividend stocks may struggle. Real estate investments may experience challenges during periods of weak property markets. By combining multiple income-generating sectors, investors can reduce dependence on any single source of income. Another important factor is understanding leverage. Many income-oriented closed-end funds use leverage to increase returns. Think of it as a homeowner using a mortgage to purchase a property. If everything goes well, leverage can amplify gains and increase income generation. But if markets decline sharply, leverage can also magnify losses. During major market disruptions, leveraged funds often experience larger price swings than their unleveraged counterparts. Investors must be comfortable with this reality before adding leveraged funds to their portfolios. Taxes also deserve attention. Depending on the type of fund and the nature of the distributions, income may receive different tax treatment. Some dividends may qualify for favorable tax rates. Bond interest may be taxed differently. Certain distributions may include return of capital. Investors should always consider their personal tax situation and, when appropriate, consult a qualified tax professional. Tax efficiency can have a significant impact on long-term results, especially for investors holding substantial income portfolios outside tax-advantaged accounts such as a 401k or IRA. One fascinating aspect of the income investing world is that many investors gradually shift their mindset over time. Early in their investing journey, they focus almost exclusively on growth. They want maximum appreciation and are willing to tolerate minimal income. As retirement approaches, priorities often change. Suddenly, reliable cash flow becomes more important than maximizing growth. The 7% dividend portfolio concept often appeals to investors navigating this transition between accumulation and distribution phases of wealth building. Of course, no strategy is perfect. High-yield investments can experience distribution cuts. Economic recessions can affect underlying holdings. Interest rate changes can influence valuations. Market sentiment can cause closed-end funds to trade at unusually large discounts or premiums. These risks are real and should never be ignored. Successful investors approach income strategies with realistic expectations, understanding that higher yields typically come with higher levels of complexity and risk. The most effective income investors tend to focus on quality first and yield second. They analyze the sustainability of distributions, evaluate management quality, examine expense ratios, study historical performance across different market environments, and assess whether a fund's strategy aligns with their personal goals. Instead of chasing the highest yield available, they seek the most reliable combination of income generation and capital preservation. Think about it this way. If investing were a business, your portfolio would be the machine producing cash flow. A machine generating slightly less income but operating reliably for decades may ultimately outperform a machine producing huge income today but breaking down tomorrow. Sustainable income is often more valuable than temporarily elevated income. As we look ahead, the demand for passive income is unlikely to disappear. Millions of Americans are approaching retirement. Others are pursuing financial independence years before traditional retirement age. Many simply want additional cash flow to supplement their primary income. For these investors, portfolios built with carefully selected closed-end funds and high-yield ETFs may provide a practical path toward generating generating meaningful income while maintaining diversification across multiple asset classes. The key takeaway is simple. A 7% dividend yield portfolio is not a magic formula, and it's certainly not a guaranteed path to wealth. But when built thoughtfully, with attention to diversification, sustainability, risk management, and total return, it can become a powerful tool for generating passive income. The goal isn't just to collect distributions. The goal is to create a portfolio that continues working for you year after year, market cycle after market cycle. Because true financial freedom isn't about making money once. It's about building systems that continue producing income long after the work has been done. And for many investors, that's exactly what makes the 7% dividend portfolio such an intriguing strategy.